Hello everyone, this is Aizwan Sir, a student of BA Honours Economics and currently studying 4th semester. Today I will be discussing with you Business Fixed Investment, a topic of Intermediate Macroeconomics 1. So let's start with it. So what is fixed investment? Fixed investment in economics is the purchasing of newly purchased fixed capital. It is measured as a flow variable, that is, as an amount per unit of time. Thus, fixed capital is the accumulation of physical assets such as machinery, land, buildings, installation, vehicles, or technology. In simple terms, business fixed investment refers to addition to stock of fixed capital assets over a period of time. Firms use capital along with labor to produce goods and services. In deciding how much capital to use in production, the firms have to balance contribution of that additional capital to total revenue against cost of using that additional capital. Before going to the main content, let's just quickly understand some basic terminologies we will be using in further discussion. So, first, marginal cost, MC. It refers to increase in production costs generated by production of additional unit. If we are producing one more unit of output, then how much of our production cost has been increased is measured by marginal cost. MR, marginal revenue. It refers to increase in revenue that result from sale of additional unit. If we had sale one more unit of output, then how much of our revenue has been increased is measured by marginal revenue. MPK, marginal product of capital. It is the addition output resulting ceteris paribus from the use of an additional unit of capital. If we had employed one more unit of capital, then how much of our output has been increased is measured by MPK. Similarly, if we employed one more unit of labor, then how much of our production has been increased is measured by MPL. Here also we are keeping other variable constant. Value of marginal product VPM is a calculation derived by multiplying the marginal product by the average revenue. Let's just take an overview of the topic. The MPK is the increase in output by using one more unit of capital, and the value of marginal product VPM will be equal to price of output multiplied by MPK. It represents addition to total revenue due to an additional unit of capital. The MPL is increase in output by using one more unit of labor and wage will be equal to price multiplied by value of marginal product of labor. Hence, for profit maximization, VPM should be equal to wage. Wage is the cost of employing the labor, whereas rental cost of capital is the cost of using one more unit of output in production. To get at rental cost, we consider interest rate as a cost of borrowing. Therefore, for profit maximization, stock of capital or desired capital stock is determined by equality of VPM and rental cost of capital. This is because if VPM is greater than the rental cost, then it is profitable to use more capital, but when rental cost is higher than the VPM, then it is profitable to use less capital. The marginal productivity of capital. The general relationship between desired capital stock and rental cost of capital at any given level of output is expressed by this equation. This equation indicates that the desired capital stock depends on the rental cost of capital and the level of output. The desired capital stock K star is inversely related to rental costs, that is RC, and the positively related to output, that is Y. Lower will be the rental cost, greater will be the desired capital stock, and higher will be the level of output, greater will be the desired capital stock. You can see from this map graph only, as the rental cost has been decreased, the desired capital stock has been increased, showing there is a inverse relationship between desired capital stock and rental cost. The rental cost of capital. The rental cost of capital RC must include depreciation rate along with interest rate. As we know, interest in rental cost includes a real interest rate, which is nominal interest rate minus expected inflation. Therefore, rental cost of capital will be given by following equation, which is this equation. It follows that rental cost of capital can change due to changing nominal interest rate or expected inflation rate or depreciation rate. Here, interest rate is the real interest rate, which is I minus expected inflation plus depreciation rate. Besides of interest rate and depreciation rate, the rental cost of capital is also affected by government tax policy. So basically there are two main tax variables. First, income tax credit, second, corporate income tax. Investment tax credit. By giving investment tax credit, government reduces rental cost of capital and thereby increases desired capital stock of firms. Secondly, corporate income tax. An additional reduction in corporate income tax increases firms' profit after tax and thereby increases desired capital stock. The stock market and the cost of capital. Rather than borrowing, a firm can raise the financing it needs to pay for its investment by selling shares or equity. When firms' share price is high, then a lot of money can be raised by selling a relatively low shares. See, if a firm's share price is high, then it can generate more money by selling a relatively lower portion of their equity, and thereby they go for stock market option to finance the investment they need. Thus, we expect corporation to be more willingly to sell equity to finance investment when the stock market is high than when it is low. Effect of monetary and fiscal policy. Decision about amount of capital stock can also change due to government's monetary and fiscal policy. Monetary policy is a set of actions or rules which on whom the central bank has the right, whereas fiscal policy is the set of rules on whom the government of a nation has the right. For example, if there will be an expansion in monetary policy, then the amount of real money stock will increases, which leads to a decrease in interest rate, which reduces rental cost as the interest rate interest rate is directly proportional to rental cost and thereby increases desired capital stock. Whereas expansionary fiscal policy leads to increase in interest rate and which leads to increase in rental cost of capital and hence desired capital stock reduces. Now we have reached to an hypothesis where we will be discussing about how much of the capital we will be raising this year. This hypothesis is called capital stock adjustment. The basic concept behind this hypothesis is that larger will be the gap between desired capital stock or existing capital stock more rapid with the rate of investment. This hypothesis explains that a firm plans to close a fraction of lambda of the gap between desired capital stock and actual capital stock each period. Suppose that the capital stock at the end of previous year was k minus 1. Therefore, gap between the desired capital stock and the actual capital stock will be lambda bracket k star minus k minus 1. Since a firm plans to add a fraction of this gap, so the actual stock of capital at the end of current year will be this. That is, just a second. That is k, which is equal to last year's capital plus lambda k star minus last year's investment, and hence investment I will be lambda k star minus k minus 1, where value of lambda lies between 0 to 1. This implies that investment per period will be a fraction of the gap between desired and the actual capital stock. The reason behind this gradual adjustment mechanism is that if there will be a large amount of investment initially, then price of capital good will be increasing more rapidly. As you can see from the graph only, that this graph, that firstly we will be raising this much investment in a fixed period, then this much period, then this much investment, then this much, then this. You can see that the investment rate had been increasing rapidly, and the And firstly, we will be raising this much capital, that we will be having this much capital, then this, then this, then this. Again, the growth of capital has been decreasing continuously. The rate of capital growth has been decreasing continuously. Now, let's just quickly discuss what is Tobin skew. Tobin skew relates to stock market changes to investment, and it is a ratio of market value of installed capital and replacement cost of installed capital. According to Tobin's, investment depends on whether this ratio is greater than 1 or less than 1. If it is greater than 1, then stock market value of installed capital is more than its cost of replacement, and in that case, firm can raise more capital through stock market to purchase more capital assets. On the other hand, when this ratio is less than 1, therefore, firm will not replace capital they have and it will allow capital assets to depreciate. Therefore, Tobin's Q is an investment guide. So, I hope you liked the video and found it useful. Thanks for watching.